You're not just buying a unit. When most people start exploring condos along the Grand Strand, they focus on the view, the lobby, and the amenities. But buyers who stay most confident long after closing understand something important. You're never just buying a unit. You're buying the building's financial health, the HOA's long-term decisions, and the lender's perception of the entire building. When buyers are often surprised is how much the building itself shapes their financial options. The logic is simple. Lenders aren't evaluating only you. They're evaluating the long-term stability of a place you're buying into. Once you start looking at condos this way, your decisions get calmer and a lot more strategic. I'm Lori Lehman Dietto with Century 21, the Harrelson Group. And today, I'm going to walk you through the condo financing and warrantability. Let's get to it. Let's talk about two words that shape the entire condo landscape: warrantable and non-warrantable. The warrantable condo aligns with standards from Fannie Mae and Freddie Mac. These aren't arbitrary rules. They exist to ensure the building has a stable financial structure and predictable long-term trajectory. In practice, this tends to matter when most of the buildings face large-scale repairs and insurance shifts. The non-warrantable condo simply falls outside those guidelines. It doesn't automatically mean that the building is struggling, but it does mean that the lending options shift. The traditional financing becomes more selective and down payment requirements might change. So ready and able buyers, pay attention here, because warrantability affects more than just today's loan approval. It influences how easy it will be for a future buyer to finance when it's time for you to sell. The detail alone shapes your exit flexibility years down the road. With a single family home, the lenders focus on the actual house itself. With condos, they look at the ecosystem around it. They're asking, is the building a stable place for a long-term debt, right? Lenders evaluate the HOA reserves, the ratio of owners to investors, and even the presence of short-term rentals. In practice, this shows up later if the buyers deepen the lending process and suddenly learns that the building finances don't meet the conventional standards. So this isn't about just restricting you. It's about creating a safeguard. A financially unstable building can create unpredictable costs for the owners, and lenders know that. Understanding this structure helps you plan decisions with more precision and fewer surprises. From a lifestyle perspective, this clarity saves you time and reduces the number of decisions you need to revisit year after year. When a condo is warrantable, your lending outlook is wide. You have access to conventional loans and competitive terms. In a non-warrantable building, financing is possible, but it looks different. Portfolio and specialized loans do come into play. There are buyers who are often surprised how quickly these differences influence the logic of the purchase. So if you know the building tends to be a non-warrantable, you'll evaluate it differently. You think more deeply about the long-term use and the building's rental model and your eventual exit plan. This is where calm decision saves time. When you pair your financial plan with the building structure really early on, you avoid spinning the wheels on properties that don't support your ultimate goals. So confident condo buyers ask strategic questions up front because they understand that these details shape both ownership and resale. These aren't complicated. They are just simply timed well. Does this building have a history of straightforward financing? How has short-term rentals here? How many are there? Has an HOA completed a reserve study recently? In practice, these questions reveal the building's trajectory, and they show you where costs might rise up unexpectedly later down and the flexible of ownership in 3, 5, or 7 years from now. So warrantability isn't meant to intimidate. It's really just meant to have a lot of clarity. You're selecting both a home and a financial structure. When you understand how lenders view the building, you make choices that align with your long-term plan. And that's not just the view from your balcony. If you're looking at condos in the Myrtle Beach area and you want to understand warrantability and how that affects your specific choices, I'm happy to walk you through that with you. Sometimes a simple conversation about your goals and a few buildings you're considering is enough to give you a clear path forward. When you're ready to explore this and with more clarity and less guesswork, feel free to reach out. Let's make sure your next move is your smartest one. I'm Lori Lee Mendieta with Century 21, the Harrelson Group. I'll see you next time.